Welcome. Thank you for joining us today. Of course, this market and this 2022 proved to be very difficult up to now. We had persistent high inflation, slowing economy growth, supply shocks from China and the war in Ukraine with Russia. So many things, and the question for today is what we should expect for the second half of the year, and we will try to assess this question with our portfolio managers. So today with me we will have Filippo Lanza, founder and portfolio manager for HI Lumen Credit Fund, Paul Marriage, portfolio manager of HI European Market Neutral Fund, and Sanjeev Bhatia, portfolio manager for HI Banbridge EM Absolute Return Fund. We will try to stay within 1 hour, so to have 15 minutes for each of our managers. Please use the chat anytime for question, or at the end of the session we will be happy to answer, so to have a bit of Q&A. With this, I leave it to Filippo for a bit of overview on the macro situation and, of course, the positioning of the portfolio. Thank you, Filippo.
Thank you, Lara, for the introduction, and thanks everybody for being here with us today. Like Laura mentioned, obviously it's quite challenging times in the market. I think we all experience a decent amount of volatility across a variety of asset classes. Our view remains quite negative on returns on most asset classes between now and the next 12 months, or at least until when we see a bit of clarity in terms of the effect of monetary policy on inflation and growth. Having said that, obviously there are tremendous opportunities that are being unleashed by the markets, but obviously those require a more long and short, truly absolute return approach, and on the other side, obviously more opportunistic kind of focus. We put this slide on our first page about the volatility. Our view is that volatility is going to be structurally elevated going forward. We think we have gone through a massive regime change. I think we've seen a lot of financial assets inflation due to monetary policy, which has been implemented ex post. So quantitative easing has been done to purchase bonds that were issued in the past, as opposed to bond to be issued now. I think that kind of QE has been morphing over the years. It's become more like bonds to be issued now, so more impactful on inflation, and has been a big compounding impact. We think that obviously created a lot of inflation in financial assets, from Tesla to cryptocurrency to real estate to many other kind of assets. And we think on the other side, there's been a lot of compression of wages, labor kind of remuneration, and real assets in general. With that in mind, we see a regime change. We're going to see deflation in financial assets, and then inflation in cost of labor and other real assets. So because of that, it's going to be a structural volatility. It's going to be higher. Secondly, I think the market structure is changing immensely. We've been speaking about it for a few years. Basically, I can summarize that as being short asset managers from BlackRock, PIMCO, Allianz, and so on, to be long investment banks. I think the crisis we've seen in 2008, 2009 will not be repeated in the same kind of way. I think at this point, banks are much more robust. They can actually capture a lot bid offer. While on the other side, asset management that have been promising daily liquidity to our investors will have actually to face the mismatch between asset and liabilities. If we move to the next page, obviously the big question mark is inflation peaking, our rates overshooting. Where are we now? We're going now. Overall, I would say our view is that quantitative tightening will continue. Will start first and then continue, and that is much more meaningful the interest rate increases. That's our first strong belief. We've been saying that for some time. If the Fed and ECB and Bank of Japan cumulatively have been spending between $200 to $300 billion a month, which is, an average of almost 10 billion a day. If that number goes down, that equates to a big monetary based distraction, a big monetary shock. That's going to be very meaningful. And I think we're just about to see that happening. Having said that, we think inflation is a bit too structural now. There's been too many things that come up also either after COVID or after the invasion of Ukraine that actually point to a more structural picture. I mentioned before the switch between, financial assets deflation and labor inflation. I think that ongoing, and that is the result of cumulated QE for the last 10 years. But to that, we need to add climate change and energy transition, which is a structural issue. On top of that, obviously, we need to add the supply chain disruption. There won't be any, reputable company out there, especially listed, that will not diversify their supply chain away from China or from Russia, whether it's energy or whether it's manufacturing, and that will be expensive. And then thirdly, and that's the most scary part, obviously, there is, we have all enjoyed this massive dividend from the peace after the Cold War was ended for the last 30 years. I think now, unfortunately, that dividend will actually become, a negative. And there'll be a lot of expenditure for, armaments. And that is the most inflationary expenditure, most unproductive expenditure ever. And that in the best case scenario, where you manufacture a tank and you leave it parked, is way worse, obviously, if that tank is actually used, because then it destroys manufacturing capacity, as we're seeing with the disastrous events that we're witnessing every day in Ukraine. So from that point of view, we see a lot of structural push for inflation, and that's our view, is that central banks will act, Fed and ECB will act, unless the war really deteriorates massively with nuclear escalation or semi-nuclear escalation, accidentally. But I think they will continue. Our fear, or our kind of base case, is that I think over the summer we'll see inflation being quite stubborn. It'll go down, but it'll be stubborn. And I think at that point there'll be a lot more risk pricing of monetary policy mistakes. With that in mind, obviously, we've been short fixed income for some time. We thought between 3 3/4 on the 10-year Treasury was a moment to take profit and reduce. We tried to be a little bit long there, but we kept for a very short period of time. So obviously, we need to be very opportunistic. As of now, I think we're entering into a new phase that will go from here to the summer, when we will see monetary policy action, but a relatively slow response from inflation. So that will be problematic. So I think now fixed income is a short. Periphery in particular in Europe, I think there is a lot of weakness in Europe. You cannot perceive the Bund as an embedded call option on Deutschmark anymore, because Germany is a lot weaker than what we thought, very reliant on oil and gas, and very much landlocked and attached to the rest of Europe. So if before, during the previous crisis of periphery, we've seen Euro appreciating, Bund outperforming, I think now we will see a reverse of that, because Germany is not the superpower we thought. There's another big issue in Europe, which is France and the nuclear energy and EDF current predicament, which makes the whole picture about Europe even more shaky. As always, we're very positive long term. Europe will come up with solution closer to a fiscal union, but not in the meantime. So for now, we like to be short fixed income, anything from corporate bonds, perpetuals, AT1, lower tier 2 to government bonds. And the more the fixed income securities got embedded optionality that is short of, or the longer the duration, like for example, in the case of the banking security, AT1 and lower tier 2 or core perps, the better the short. And it's going to be the main source of liquidity for the fund if things go badly, because that's where the liquidity pain will be. That's where the oversupply will be in the market versus the demand. If we move to the next slide, just an example of some of the macro opportunity we choose to take this year. As you know, we've been very bearish. China, we think China is an immense bubble. They're going through a subprime crisis there, probably worse than the subprime we've seen in 2008, 2009. Most of their expansion was due to fiscal input predominantly around the real estate market. We think population in China has been overstated for years, and there is a big issue for real estate. The one kid policy has been disastrous, and that unfortunately has been going on for so long. This is going to have a compounded effect over the next few years. There's a big political election in China between now and the end of the year, where Xi Jinping is trying to be re-elected pretty much for life. We think China is much more imperscrutable than Russia, for example. There's a lot less information, so there is more possibility of tail risk. We've been bearish China. We remain very bearish on China. We keep shorts on China. The biggest position this year has been the renminbi versus dollar. We had the first attempt at that beginning of the year. We stop loss that position, and we reestablished towards the middle of the first quarter. That worked very well. We still think there is a lot of pain on financial assets in China coming up. And I think China remains for us like a structural short. We're very opportunistic about it. We had a big position on China CDS shorts on the sovereign side. We kept it, and we've been reducing. At the same time, obviously, we're not a perma bear fund. We don't want to be that. It's not our mandate, and it's not my desire. Our desire is to try to make money on any kind of market environment and try to first protect capital, then maximize the opportunity. So with respect to China, I think we've seen a lot of, we think, Chinese renminbi, Chinese credit, they're still very much under pressure. There is a lot of pairs in the tech sector. Are we going long outright? No, because the issue that we talk about, military dictatorship, heavy regulatory environment, and unpredictable economic future. But having said that, the Hang Seng has proven a perfect tool for us to play those vicious bear market rally that we do expect for the next couple of years. Overall, we think most financial assets will have negative return over the next 2 years. So I think it will be very important also to get the kind of bear market rally right. So we've been using Hang Seng because it's liquid, because it's an index, because it's traded pretty much 24 hours around. And we've done that, for example, this year versus Euro Stock and S&P, and it worked very well to basically capitalize on some of our shorts. And it's something that we keep on looking at. So we have this conversation with investors. I think there's plenty of way to make money in these markets. One obviously is to be short. The second one is to play the bear market rally. And then thirdly, there'll be plenty of pocket of values. Talking of which, if we move to the next page, we can go through some of the pocket of values. The big pocket of values will come from the solutions to the problems. We had solution to the problem with COVID. We were very bullish in 2020 after the COVID explosion because we thought there was plenty of solution, both from a monetary policy and from a technological kind of single company point of view. Now the picture is way worse. I think monetary policy is actually one of the sources of the problems, and there's very little they can do. Fiscal can help, but fiscal is already overstretched, and they will create more pressure to government bonds and fixed income. So we basically left with the main driver of value will be companies that can come up with solutions. So, for example, one big thing for us is energy. We really like gas liquefaction and anything that add to LNG capacity. That's going to be the one big issue going forward, not just for green energy transition, which is marginal, not great, but better than oil, and coal, obviously. But LNG is one big thing also for the current geopolitical predicament we're in, and which we think is here to stay. I think Germany has done a series of tremendous mistakes under Merkel leadership, not just in terms of European Union, but also in terms of energy policy. France has a very, very dangerous situation with EDF and the nuclear industry there. So Europe overall is in a dire state from an energy supply point of view, and the clock is ticking. So we think anything that's got to do with LNG solution is a great play. We have New Fortress Energy that we've been involved for some time. We're still looking at little pearls and pocket of value there. That's going to be one big opportunity and one big solution to the current problem. Another big solution to the current and anything which goes into the energy transition, whether it's hydrogen, whether it's solar and wind. Obviously, you have to find the right place. A lot of places were overvalued. But as the oil price goes up, as the geopolitical tension goes up, obviously the break even the opportunity cost of capital shifts, and that makes some of these opportunity great, and we really like them. A corollary that could be electric vehicle, which obviously is a slightly less attractive and exciting way to play, but again, still part of the solution. One other theme where we're really working on is food security. We've been involved with names like agronomics. There is very few play in the market, but we think, you know, anything that's got to do with food security will become of paramount importance going forward. So anything which is, you know, self-generated, or anything that's got to do with agricultural solution, again, that's where we see the opportunity going forward. We have a lot of inflation now, but we believe technology is accelerating the speed of innovation. That is a structural change, and technology will create deflation. But obviously the companies that bring that deflation will be the big winners. Those are the guys that are going to pocket the money. And we're going to try to be in those plays. Obviously there are equity plays. We're trying to be very diversified. But, you know, whether it's LNG, whether it's hydrogen, whether it's, you know, alternative food production, we're trying to have a portfolio of diversified bets, which we do market neutral. But I think those are going to be one of the biggest pocket of value going forward for the market we're in. The other pocket of value, if we move to the next slide, which is the last one, is obviously the stress credit universe. You know, we've been talking about it, you know, ad nauseum with investors, that there's a lot of over-levered plays. There's been this big bonanza of private equity going on for too long, in our view. There's a lot of capital structure which are totally overstretched with very poor covenants, a lot of like ETF and UCITS and whatever else, daily liquidity fund for structure that have got, you know, an average duration of at least a couple of years. So we think we'll see two things. We see fundamental capital structure being stretched and broken. And then we will see a need for restructuring, need for recapitalization on one side. On the other side, we will see a big overreaction. You know, we will see whether it was this year on stuff like EDF or SIPEM. I think we will see plenty going forward because the demand and supply on those corporate bonds was great before. It won't be the same going forward. So we see that's going to be a big opportunity for us because as long as we do the right fundamental work, we're going to be prepared for when the liquidation is going to come through. And the liquidation will be violent because there's too many asset classes which are, you know, presented as daily liquidity when they're not, or even worse as ETF. And on the other side, unfortunately, on the demand side, the amount of funds that like us can actually play in that realm have diminished massively over the years. And then obviously investment banks have switched completely business model since the long-term capital or the 2009 kind of environment. Investment banks do not take risk. Investment banks will trade as broker, as intermediary. That obviously will over dramatize any price reaction, and there will be a great opportunity because it means your entry point is going to be way below fair value. On the stress side, we have a few positions. You know, we can move to the next page. Actually, I think we simplified some names. We have names, especially on the telecom sector, especially when it's got to do with infrastructure, where we think there is a very strong, you know, capital protection, a very strong recovery value. On the telecom sector, we like Oi Brazil in Brazil. Brazil is probably the only country we really like from a kind of, you know, macro point of view. All the rest we're quite negative. We like Oi Brazil as a telecom name. It's trading at 20% yield, brilliant bond. Similarly to Dish, which is really creating a new proper competitive 4G, 5G player in US. So that's the other big pocket of value we see. So just to summarize, lots of volatility going forward, lots of opportunity for long and short, opportunistic, overall short, but ready to go long for bear market squeezes. And then obviously plenty of pocket of values in company that represent solution to the current problems because capital will jump into those companies and they will do really well, whether it's food or energy. And then on the other side, be ready for the distress wave, which is going to be overwhelming compared to the ability of the market and the players to absorb it. Thank you.
Thank you, Filippo. Just a question. So in terms of, it's clear that at the moment you are playing a lot of macro opportunities while waiting for, say, the long side to be on the distress opportunity. What can really change the picture as catalyst to make you more bullish? So is the resolution of the conflict something that could completely change the picture today, or because of the tighter monetary policy, at the end of the day, it could be just a short relief, and then we're still in the same place.
I think in terms of short-term relief, we definitely see a potential settlement on the war front. Our view, and has been the same for some time, is that we did expect Russia to invade, not to be so disastrous from a military point of view. But I think we're to a point now where clearly there is a lot of there's a strong interest from whether it's US or China for the war to continue and to weaken progressively Russia. We don't believe this China support of Russia is real. We think, if anything, they want Russia to be weakened. So on that, yes, we think it's a relief, but fundamentally, I think there is too many vested interests for this war to continue. I think Europe is very, very weak and incapable of projecting, political decision. I think Europe is weak because they rely on the oil and gas, and then the energy sector in France is not that reliable. So I think there could be a relief, there could be a settlement, there could be a meeting, there could be something. I think if it is, it'll probably be a shorting opportunity, because I don't think we'll create stable peace there. The one thing that will make us change our view substantially and considerably will be the inflation performance. Inflation going down way below 4, that could be a trigger. Our base case, I think, is that we will see a lot of monetary policy actions being taken between now and the summer, but inflation will be relatively stubborn. Maybe we have a bit of a rally as the first policy action get taken, as they are priced as being effective. The reality is that we think they're not going to be effective because there's too much structural drivers for inflation. But that could be one. Obviously, as for COVID, the other big driver would be technological solution. We big bulls on technological solution to the problems. There's the speed of technologies is changed. Like we've seen with COVID, what we thought would have taken 3-4 years is probably taking 6 months now. And the same will be for the energy transition, will be the same for the food supply. And I think the companies that will come with a solution for that will be really good. Then again, that could be something that we monitor, and we're trying to be long those. But I think those will be the 3 drivers. So short term, the war, obviously more long term will be inflation going below 4 substantially. And then thirdly, the technological solution. Obviously, one big caveat is that on the second scenario where inflation goes down, obviously depends at which price, because if the price is a global recession with ongoing deglobalization, then I think it could still be a very big short or a negative for overall financial assets.
Perfect, thank you. So with this, we move forward to Paul Marriage to cover the European market. Of course, the fund has also, say, a good allocation to the UK market. So Paul, I leave it to you to comment on 2022 positioning for the fund and macro views, even if, of course, the fund is always playing neutral, the market. But if you have particular thought on the UK market, I think it could be particularly interesting for our counterparties. Thank you.
Thanks very much. Thanks, Laura. Morning, everyone. Yeah, so just to remind you, this is a bottom-up equity fund, long short. That's kind of what we do at Tellworth. Our expertise is, predominantly UK, and this strategy is 70% UK, 30% pan-Europe. So, UK is a big theme for us, and I'll try and cover that off for everyone as well. And I think generally, if you look at this year, we've been more successful making money in the UK market than we have been pan-Europe. And I think there's probably quite good reasons for that. Primarily, that we're just a little bit further from the Ukraine crisis here in the UK, and it just doesn't seem to impact our market quite as aggressively, and it's probably given us slightly better opportunities just on that. But I think one of the things that we're seeing generally is the more investors are getting used to Ukraine headlines, inflation, food shortages, etc. Time is a healer. It isn't a healer for people at the end and they're facing these things, but in terms of the stock market, the kind of new negative bad news is being consumed more easily, and we're in one of these periods where we know there's a conflict going on in Ukraine, we know we've got inflation, and we know we've got some pretty challenging long-term outlooks. I think one of the really interesting things about this year, and I've been running equity long-short strategies for nearly 20 years, is that the companies we meet thus far have not really seen significant headwinds. I mean, some specific companies, specific places, online retail in the UK, for example, has been weak this year. But generally, the broad range of companies we meet across sectors have set expectations they're comfortable with. So we meet management teams who are running businesses that are generally doing well. They are meeting and in some cases beating earnings expectations that they've managed well. But they're conscious that there's a lot of economic noise and they can only really give outlooks that reflect that. So I think one of the big challenges this year will be we probably need to start seeing some of those companies that we've been very confident in the first half of the year beginning to warn on earnings in the second half of the year. That process needs to happen before people can get excited about equities again in the rest of 22 and 23, because we all know that once that process starts, people will start saying, right, when's the recovery year? Is it the second half of 23? What sort of valuation are we on for second half 23, Q1 24? Does that make the market a buy today? So it's that process we're getting closer to. I think we've probably gone past kind of peak doom and gloom in equities. Possibly some more wobbles there to come, but we'll see. I think we're all conscious that the worst economic data may yet be ahead of us, but if the market's thinking that now, then when it comes, ironically, that might actually be a point at which things get a bit better. I think one of the areas that we don't think the market's really thinking about that much is the potential food inflation and supply challenges. As European harvest season gets underway, obviously this is the global market with planting and harvesting seasons all over. I won't go back over how important the Black Sea area is to commodities, soft commodities going particularly into North Africa, but also places like the French wheat harvest, very important. How much is available for export. So I think the stock market, which has historically been relatively weak on agronomics and the importance of agriculture in the global economy, is probably missing this one. So we're very conscious of that in the way we're looking at companies and what sort of impact that might have. I think that's a bit of a left field risk to markets that people are probably talking about enough. Not that many stock market ways to play it, but you think about the kind of secondary impacts. I think today, if we look at what we've experienced so far this year, choppy markets, super volatility, intraday, intra-sector. I think basket trading impacts that a bit. The baskets, thematic baskets that investment banks have become, it's become a very important profit center for a lot of equity desks. And a lot of fund managers use those baskets. They create extra volatility. That's fine. We've got to accept that, but we've also got to get used to it. We've talked about confident outlooks versus the recessionary outlook as a persistent theme. So managements are okay. Recession is what everyone's talking about. At some point, those two things have to meet. I think what we've done really well this year is some of our tactical trading has been good. Most of our trading is kind of 6 to 12 month view, but some of our tactical trades have been excellent, particularly in defence. We've always been minded to own a bit of defence. We've not had an anti-defence view at Tellworth. In fact, we've always seen defence as ESG friendly, securing our water resources, securing our future. I think it's an ESG friendly thing to do. Now, clearly, Ukraine has made defence investments much higher profile. So we've done well in things like Rheinmetall in Germany, Kinetic in the UK. But on the energy side, we were relatively early into the oils with BP back out of last year. This year, fairly early into GTT, which is a gas transmission play. If a lot of investment needs to go into gas transmission, GTT will be a winner in terms of designing terminals and stuff. So we've done quite well on some of that short-term stuff, and that's good news. On the short book, it's generally been a theme of shorting blue sky earnings hope, which is no longer as easy as it is. It is no longer as easy to justify. So Oxford Nanopore, great long-term biotechnology, medical technology play, but the rating doesn't stack up. When you've got an 8 billion market cap, which might be worth 1 or 2 billion on the normal rating, the fact the share price has halved this year, could be more to go for. Massively competitive takeaway market that was clearly massive. It was boomed in COVID during the pandemic, normalizing now. And post-COVID normalization is a big background theme for a lot of companies, and how to manage that, and how generally post-COVID normalization has been worse than people expected, i.e. sales have normalised more quickly. The high street's probably been a bit better than people thought, like retail footfall. But those companies that felt that COVID was a structural change away from physical retail have generally been proven a bit wrong so far. Maybe we could have a quick look at the next one. So just give you a little, how we use the combination of things to kind of bring us towards that portfolio, just reminding people really, lots of fundamentals, lots of company meetings with management teams, and then a few extra screens. Data is really important to us. Data's been helpful to us this year. So we source a very broad range of data, put it into a number of screens, and that gives us great pointers on things like retail, particularly consumer spending, and that really helps the direction of our questioning and the choice of our stocks. And that's really helped in e-commerce this year in getting some of those shorts right. And we also have our accounting shorts in Sinners as well, and making sure that where we're concerned about the quality of a company's earnings, we can be short, and that is for us a basket, but a custom basket made by us, not purchased from an investment bank. So some of the key themes, generally this has been a good year for the process, I'd say, in terms of generating good ideas from our kind of data-led approach, which is parallel to meeting companies and pretty key to what we do, and is probably stronger in the UK part of the portfolio. So yeah, let's have a look at the other one. And you can see, team-wise, we've got Fred focusing on Europe, Seb on the UK. I kind of bring it together in the middle. It's not small cap. You might know Tellworth is well known for small cap. We don't do small cap in this fund, so it's liquid, it's tradable, daily dealable. So we need to be tradable. We're generally slightly bigger cap in Europe and slightly more mid cap in the UK. And we really do try very hard to stay neutral here. We're running a gross of about 150. We are pretty much flat in terms of the net. And it's not just balance sheet neutral, it's about being factor and style neutral. And style neutral is quite important because, if anything, markets have become, more style volatile as well. And, last year, very much, it was, COVID open, COVID closed, value defensive. These factors really drive markets, maybe a bit less so this year, kind of moved on from the open close COVID thing. And we've probably almost switched to a sort of war winners, war losers type factor, but keeping neutral there, which is actually a lot about making sure the short book's fully populated, is really how keeping the net low, being a genuine market neutral fund. So, I think overall we're grinding out returns there. This has been a difficult year to deliver positive returns. We are positive, and we sort of expect that trend to continue. But low volatility, modest returns, keeping at it, and no shortage. Like Filippo said, the opportunities at the moment are great. Actually, it's a question of not spending too much time on too many different opportunities and focusing on the ones you can really execute on. So that's kind of where we are at the moment. Just giving you a little bit of colour there. As I said, keeping it pretty flat. We've nudged the gross up a bit. I think this year overall, I think we felt that the positioning was right, and actually it's a time to have slightly higher gross. If nudging out 25 bips here, 20 bips there, small numbers, but you need a slightly higher gross to squeeze those, but we're not talking massive numbers here. And clearly indices have been a big part of our shorts. Our UK short basket there is our sellers basket, and you can see overall that UK stocks are a pretty important part of the mix. So I think balanced positioning, having to work very hard to keep everything in line, working hard to deliver small positive returns. I think it's going to be more of the same. I probably have a slightly more positive view on markets than some people. I think we're going to look forward through some of this pain this year. Probably, I think the risk of some sort of rally, even if it's a bear rally, is relatively high going into summer and Q4. And making sure we're on the right side of that is really important for us. So that was a brief run through. Obviously, happy to pick up some questions or pass on to Sanji.
Yeah, just a question from the audience. On the outlook, if any particular views on banks, of course, because of the interest rate cycle. And so if you have any particular position on the sector, either long or short.
Yeah, so we've generally been long banks. I think banks are probably not a forte for us sector-wise, but a few tactical long banks, but mainly beta has been good. I think we're not playing the short, periphery banks trade, a bit like Filippo. We're trying not to repeat those trades from the financial crisis. I'm not sure they all work in the same way. We've got enough. I think we've got enough short ideas and enough general strategy ideas not to play the banks too much. I wouldn't say it's an area of strength for us. But thus far, as you can see on there, BNP and our top 10 longs, we've also been long Barclays and long OSB, which is a challenger in the UK. It's been a good beta trade for us. And generally, we've been indexing that out in our futures rather than trying to be too clever with fundamental bank kind of research, which I think is difficult. I think banks are pretty difficult to get right, frankly, from a personal perspective, and that's probably reflected in the team.
Perfect. Thank you, Paul. With this, I would move to Sanjeev for just cover the emerging market. Again, it has been a super difficult environment. We all know that China has been super tough this year. We already covered a bit with Filippo, but I'm sure that our audience want to know your view, Sanjeev, on the macro, starting from a macro point of view, and then I think we can go on some areas in particular, so China and Latin America, which have behaved quite differently year to date. Thank you.
Thank you. Thanks, Laura. So we started, let me just start with trying to look at history and see where we are in the world and what's going on. And so we've got a couple of charts here showing inflation and showing what's happening in the rates market. And what we see is that 2022 is one of the best years for commodities and one of the worst years for bonds in history. And it's quite an extreme move. Now, when we look back in time, there are similarities to the 1910s, and then there are similarities to the 1970s. And both of them are sort of relevant. If you look back at the 1910s, we'd gone through this huge period of globalization. There was a huge surge of innovation. You had, airplanes, cars, production line, Model T Ford, all of these deflationary things that were going on. And so you had innovation, deflation, huge amount of globalization, and then you had a sort of rivalry between empires in Europe that turned into a hot war. And fast forward today, we've had a period of huge amount of innovation. We've had a huge amount of globalization. You've got political tension between large empires, so whether that's US, China, US, Russia, combined with China, and we've turned into a hot war. And so there are quite a few parallels. And if obviously in the 1910s, you had a chain reaction of that hot war turning into a world war. We haven't seen that yet. There is a risk. It's something that the parallels are there, and we need to be thinking about. But if you look at what happened during World War I, you had high inflation and really bad environment for bonds, and that's similar to what we've had this year. If you go back to the 1970s, which is the more, sorry, stay on that slide, yeah, which is the more of the example that people have been using and commenting on. You had a proxy Cold War, hot war going on with Vietnam. You had easy monetary policy, debasement of currency. The US came off the gold standard, and you had an oil shock or an energy shock to combine with that, and then a hot war in the Middle East as well, energy embargoes, and again you had very high inflation. The bond markets were not so bad because bond yields had already been going up for a long period of time. And so the bond markets had poor performance for a long time, but it wasn't the kind of carnage that we've seen in bond markets this year. Both of those have parallels to today, especially with the hot war in Ukraine, leading to the things that we mentioned on the call before with food supply issues and etc., as well as energy supply issues. And those are the two big driving factors that we've been focused on in the portfolio. And then we can think, and then we'll come on to talk about China separately because that's a completely different situation. But if you think about what's going on in the rest of the world, we're in this sort of some sort of combination of the 1910s and the 1970s, and it's not a great environment, and history is sort of repeating itself in terms of how those environments are played out. We can move on to the next. Right. The other thing that's been interesting and has been a very big mover over the last few years has been the diversion between sectors. So the left chart there shows you what energy has done in relative performance to the S&P, and you can see that it's energy relative to the S&P is back to Great Depression levels, and part of that is driven by divestment campaigns and ESG. Part of that is driven by a lack of capex in energy, and we think there's a huge opportunity for a catch up for energy stocks. The real question is how much impact is ESG and those type and divestment concerns going to have in terms of people being able to invest in energy. We've been running positions in oil services companies. We've been long. We were long the Russian oil and gas industries. That fortunately we cut half those positions ahead of the Ukraine tensions, but we still got hurt a little bit by our holdings in Lukoil and Gazprom, which were two of the cheapest energy stocks in the world prior to the Russian invasion. So we think there's a huge opportunity in energy structurally, but energy has been beaten down really because of ESG. If you look at what happened at COP26, and something we just spoke about in our previous webinars is the energy industry being starved of capital because of ESG reasons. And we think there is a shift that will happen eventually by governments as the energy situation becomes more critical, whether that is opening up of North Sea oil, more fracking in the US, etc., offshore drilling in Brazil. All of these things will slowly, I think, start to re-engage as the world realizes that we need reliable hydrocarbon energy for a considerable period of time, and net zero is a nice to have, but in practicalities the costs of getting to net zero are going to be extremely high. So we've been long, so we're still long oil services companies. We think that's where the best leverage is to play the energy sector, because we think there will have to be more production, and more production requires capex, that requires the specialist energy companies to be coming in and getting more work. On the flip side, we've seen that the money has all been piling into tech. If you look at the relative performance of technology stocks, we're back above the dot-com bubble, and also the other period where we had a very big outperformance in technology stocks historically was in the 60s, and we'll come on to that in the next slide as to what's going on there. But it was a case of, the 60s was a period of low inflation, etc., and easy money, and there was a big move of capital into tech and growth stocks and big caps. And so we see kind of three peaking points. The peaking in tech in the early 70s was rotation out of tech and into commodities. In the 2000s, it was rotation out of tech and into housing. And now we feel there's going to be a rotation out of tech and into commodities again, or into energy. So that's sort of how we're positioning our portfolio to some degree. The other areas that we're focusing on around that is food and food processing. So we've been short companies that are in the supply chain of food, because we think passing on pricing is going to be difficult. There could be rationing of supply, price controls. So for example, a company like Gruma in Mexico that produces tortillas, how politically acceptable is it going to be for Gruma to raise prices because of their input cost increase. And so we think there's going to be significant margin pressures in that agricultural supply chain, especially the companies that face the end consumer. The political pressure to not raise prices and keep inflation under control is going to be very, very high. And so we think those companies are going to suffer. Meanwhile, we're long companies at the raw end of that commodity space. So the farming stocks, the actual producers of the agricultural production companies, because we think they will have pricing power within that supply chain. So just recapping, a couple more interesting dislocations and things where things have got to turning points. So look, we think that we've had a period where the US markets have outperformed everything else. So the left chart shows you US performance versus the rest of the world, and you can see how far out of kilter that has got. The periods that we can reference, again, the 60s, where you had the Nifty 50 big cap rallies, and again, today's markets are a big cap dominated market. And again, in the late 90s, where you had the tech bubble, the internet bubble. So we see similarities there, and we see a rate hiking cycle causing that to reverse. And compared to EM, on the right-hand chart, so the EM has had 3 major periods of outperformance. One in the 70s, so that's the line going down is EM outperforming. So one was in the 70s there, which was again higher energy cost, higher commodity prices, and the EM at that time being dominated by the primary industries, the commodity producers. The second was, and the other period of outperformance was in the early 2000s, where we see the opening up and globalization and opening up of world trade. So if we go to the next chart, we can talk about where we think. So just to reiterate those points, EM's best periods were in the 70s with high inflation, in the end of the 80s, early 90s with the opening up of Eastern Europe and the fall of the communist regimes, and then in the early 2000s with the opening up of trade and trade liberalization. You had GATT, WTO, China came into WTO, and that led to a huge boom in global trade. And those have been the 3 sort of golden periods for EM over the last 50 years. If you look at the geopolitics and the tensions between US and China, it's hard to see trade liberalization improving. And we may be going back to what we had in the 1920s, where trade liberalization went into reverse, tariffs, and that led to the Great Depression. But we do have the 1970s inflation side of things, which led to EM outperformance and was a very good period for EM, again, because EM was dominated by those primary industries at that time. There was no tech, there was no China, Alibabas and those things in that period. So we're looking at focusing on those Brazil, agricultural type businesses, Indonesia, etc., for that 1970s style outperformance. And there is a possibility of getting a late 80s style unexpected bonus rally because of some sort of resolution around Ukraine and Russia, maybe a regime change in Russia, and a kind of new peace dividend along those lines. That's the kind of the optimistic case, and that's so we think there's definitely a case for a bull market in the primary industries in emerging markets. There is a case of a sustained EM bull market if Russia has a regime change and and we get the peace dividend that we had in the late 80s, early 90s. And the more complicated part is China and trade. Xi Jinping is likely to get re-elected at the end of this year for as Filippo mentioned, to become president for life. The tensions with China, we think, will continue to grow, and China does have a lot of domestic problems, and so the willingness to blame others and could we get protests as China's economy slow down? Could we get a Tiananmen Square type scenario again? All of these are possibilities. It's going to be incredibly difficult to predict what happens with China in an economic slowdown, because we haven't had one really for 30 years, and it's going to be a black box, and it's going to be incredibly difficult to read. But that's the wild card in our outlook on what's going on. So just to reiterate where we think the opportunity set is, agriculture, commodity mining, energy, we think are all areas where we think we can see great returns. On the short side, we're focused on companies that are highly energy intensive, so things like cement, industrials, food processing, and end consumer related businesses. The one that has hurt us this year in terms of performance, so those kind of thematics have worked quite well in our portfolio. Where things haven't worked, and the big conundrum for us has been the semiconductor industry. We have been very big bulls on the semiconductors for the last 3 or 4 years. As technology has advanced, as people move to a world of 5G, artificial intelligence, semiconductors are core to that build out. And what we've seen is a huge derating in the semiconductor industry over the last few months, even though the fundamentals are still incredibly solid. Earnings growth is great. Pretty much every semiconductor company in our portfolio has beat earnings and raised guidance, and yet the stocks are down between 20 and 40%. That's been the area where our portfolio has lagged and caused most of the pain in our portfolio. Outside of that, we've actually been making positive returns. So it's been a very tricky market, as Laura has mentioned, and the really confusing one for us has been the semiconductor derating. We think it's wholly unwarranted. We're continuing to keep our weight and our positions in the semiconductor industry. I mean, these things have now derated to a point where you go, while we are at trough valuations, the semiconductor industry is being priced as though it is already at the bottom of its cycle, even though we've got a phenomenal growth outlook for at least the next 2 to 3 years in that industry. So that's how we're positioned. If there's any questions, we can go through with it. And if we want to talk about China specifically, we can do that.
Yeah, maybe Sanjeev, just a question from the audience. So how much do you have in China, and if any, what kind of sectors or stocks?
So our weighting in China has been the lowest it's ever been in our portfolio. I've been looking at EM for coming on to 30 years now, and I have never had an exposure this low in China in those 30 years. And our exposure in China is down to the similar levels to our exposure in Russia before Russia imploded. So we're down into the 1% weighting in China, concentrated into one name, which is Baidu. Effectively, Baidu is a leader in 5G, Internet of Things, automation, smart cities, all of the things that the Chinese government wants, and all of the things that are the cutting edge of technology. So whether that's driverless cars, whether that is mapping, I mean, it's the Google of China. But in some areas it is way ahead of Google. So that's the sort of forget search. That's an old school business. If you look at the new businesses, 5G, artificial intelligence, smart cities, self-driving, robo taxis, in a lot of those areas, it is ahead of Google, and it's a core component of the new innovation world that we're going to be living in. And so we have a position in that. Even that stock has gone down 50% this year, to give you a sense. And yet we think structurally it is one of the biggest winners in China over the next 5 years.
Sanjeev, so you still ran with a low gross exposure. What could you make you change? So starting to really build, what could be the catalyst? Again, a resolution of the conflict?
Yeah, so we started to, I mean, we're getting to valuation points where it's getting very interesting. So we actually added to our China exposure in mid-March. Unlike Felipe using the Hang Seng index, we used the HSCI index, which is a more tech and China domestic, A-share and tech dominated index. And our view was that index got to a level about 6,000 in mid-March, and our view was at that level that we would start adding and scaling into a more significant position. It stayed there for about a day and then rallied 20% in the next 2 days. We took the profits and are waiting again for those valuations to show us the lows. So, we think China is probably about 10% away from structural valuation lows where you can say, okay, you know what, the risk reward is just fantastic here. And then we can manage from the valuation and entry point, we can manage the risks going forward. We're not quite there, but we got there in mid-March. We had a big bounce. We're now drifting back down to those levels, and we think those are the entry points for us from a valuation point of view. We're getting at those levels. You're getting close to a PE multiple of about 6 times. You're looking at dividend yields of 4 or 5%. You're getting towards price to book numbers of 1.2. So real kind of trough depression type valuations. And so at those levels, we think the risk reward is quite compelling.
Perfect, thank you. So we open up for further question from the audience. Let's see if we have any. So at this point, we don't have other questions. I think we pretty much covered the view of for all our markets. Of course, we think the long-short strategies could be the right way to play the market at the moment, since there are still many uncertainties up there. And so even if, we have better valuations, it's not probably the time to aggressively enter directionally on this market, but a lot of opportunity on dispersion. We thank you very much for your time. Of course, we are still available for any follow-up, and thank you to Filippo, Paul, and Sanjeev to spend the time with us and give us the view on the markets. Thank you very much.
Thank you, Laura.
Okay, thank you.
Thank you, bye.
Siamo rimasti solo io e te.
Credo di sì. Credo di
Velocissimo, non ho fatto tempo a cercare il link. Mi mandi il link invece quando puoi, così lo mando anche a un po' dei nostri investitori.
Sì. Ok.
Perfetto. Grazie.
A dopo.
Ciao Laura.
Ciao.